Hello friends, this is Vijay Bhambwani and I'm back with you in my weekly market outlook videos. I'm very pleased the way we have been managing to keep ahead of the crowds, managing to keep a few steps ahead of the broader markets and in calling out the market trends. And as I told you last week, that the selling is not over yet, and that's precisely what you saw the way the markets corrected on Friday and of course in the beginning of the week itself. I kept you ahead of the curve saying that the RBI retail direct GSEC market would impact the collection of the banks when it comes to bank FDs because of the differential in yields of the GSECs versus the bank FDs, and of course the sovereign guarantee factor. All that played out beautifully, and in this video I have an update for you as to why I think the markets are undergoing or likely to undergo even in the future some amount of churning. And this aspect I will cover when I reach the 10-year benchmark bond yields in the bond markets. Do remember that I have been ahead of the curve, ahead of the other YouTubers when it comes to bond markets and the dollar index, and marrying the signals of the various asset classes to give you a holistic 360-degree view. So let's plunge right in and we go and check out the market roundup window, which shows that the markets attempted to rally last week, and it was a Nifty which led the charge on bear covering. Bank Nifty underperformed along expected lines. The US dollar index remained firm, and that kept oil and gas under pressure. Gold rose marginally on safe haven buying, but silver fell. The USD INR rose, which indicates mild weakness for the rupee. That kept our equity market up moves restricted. The 10-year benchmark bond yield went up mildly due to inflationary concerns. The NSE gained 1.08% in market capitalization on a week-on-week basis, and the market-wide position limit chart, as you can see on your screen, shows that the figure went up along routine lines because traders ramped up their exposure. This is normal till the third week of the derivatives series. The index and stock futures volumes, remember this is cumulative of three derivative series, which is December, Jan and Feb, shows a decline on a week-on-week basis, which is partly attributed due to the extreme volatility which we saw in prices. Watch this space keenly in the coming days. Now on your screen is the basis chart, which is the premium enjoyed by the futures over spot. This shows that the basis rose because short covering at lower levels propped up prices. Now, for our most exclusive in-house reliable study that has been standing the test of time, which is the Impetus chart, which comes up on your screen, shows the Impetus values falling across the Nifty and the Bank Nifty. And remember, last week, these indices have attempted to rally, which means the up moves were on very poor impetus. Ideally, we want price and impetus reading to rise together for an up move to sustain. And the present scenario points towards a bear covering rally where bulls are relatively cautious. We need a lot more aggressive buying support from the bulls before we are out of the woods yet. Let's check out the footprint of the various category of investors here. The FIIs, where index futures are concerned, ramped up their exposure to 59,411 lots against last week's 30,099 lots. Where their stock futures exposure is concerned, it shot up to 1,56,856 lots against last week's 38,692 lots. Where DIIs are concerned, they covered a little bit of their index future shorts, which are now short at 70,262 lots as against last week's 71,719 lots. Let's take a look at their individual stock futures exposure, where the shorts went up to 16,73,202 lots, which was last week a net short of 15,81,535 lots. Where prop traders are concerned, remember these guys are second best to insider traders because they know who's buying and selling. These are brokers' own individual trades. Prop traders went net short in index futures by 1,306 lots, whereas last week they were net long by 18,740 lots. Where individual stock futures are concerned, they reduced their overall net long position to 206,464 lots, which was earlier 220,058 lots. Where retail traders are concerned, now this you must pay particular attention to. Where retail traders are concerned, their stock index futures, fell to net long of 12,157 lots, which was last week 22,880 lots. Now pay attention to the stock futures longs, which fell marginally to 13,09,882 lots, which was last week 13,22,785 lots. So their stock futures longs have come down marginally, which means the bulk of their long positions are still intact. They have not yet squared up their long positions, and the retail segment is basically doing all the heavy lifting with the biggest long in the market, and that can make the markets even more volatile. So watch this space very carefully. Friends, let's now come to the bond market. And this is the segment which might cause a churn in the equity markets in India. And therefore, this is the most critical aspect of this video in this week. I have been earlier than the others in telling you that the bond and US dollar metrics need watching. And what I have been putting up on my social media accounts on interest rates since months and quarters is now coming true. Interest rates are rising, which means the big ticket check writers are now resisting lower interest rates when inflation is rising. And the borrowers are willing to pay higher interest rates, as HDFC Limited, Bajaj Finance and HDFC Bank have done last week. This is exactly what I have told you in my earlier video, that the RBI bond window will mean banks and NBFCs will be forced to raise rates. That means the cost of funds will be driven higher. That is one red flag for equity markets. Secondly, there is a risk of shift in asset preferences if the interest rates rise even further. Savvy investors know which side of the bread is buttered, and they move their money like pieces on a chessboard, and they've started shifting assets partially from equities to fixed income as interest rises. So if interest rates rise even further, there is a risk, a perceptible risk, that money may shift from equity funds to debt funds, and that is causing a churn in the market in the future. As a matter of fact, I told you last week I've already started a slow and calibrated shift towards sovereign investments. As rates rise, I intend to resort to laddering. Now, laddering is a concept where you start nibbling into sovereign investments of various tenure, so that your interest and the redemption is coming in a staggered manner at periodic intervals, so as to look after your cash flow requirements in your later years. So laddering is something we've already started. I hope that I'll be able to catch the rally in the interest rates as they go along. Now, If this strategy suits your temperament, maybe you can consider it for yourself also. And laddering basically ensures return on and return off capital. It's a fairly reliable strategy for an astute investor, especially old world traders like me. And this is something that keeps you kind of protected for a rainy day at a later date. Now, last week, bond yields rose, which means bond prices fell, which partly explains the underperformance of the Bank Nifty. Remember, I said partly. When bond prices falls, there is a mark-to-market loss to the banks as AFS, which is available for sale, and HTM, which is hold till maturity holding of bonds, suffer a portfolio decline. Now, do keep an eye on this metric in the days ahead. Of course, I will be keeping you updated on my social media accounts as well. Friends, let's now move to the US dollar index, the Dixie, which rose on 3 out of 5 trading sessions and logged 0.08% gains. It barely managed to hold on to meager gains on a week-on-week basis, and the price is just above its 25-day exponential moving average, which happens to be a month-long holding on cost of the bulls. There's been a mild resistance at higher levels, and which is actually good for emerging markets, including India. Now, as a strong dollar is actually an anathema for most of the emerging markets. It triggers inflation, it impacts our balance of payments, especially our external debt. Now, let's take a look at the weekly chart, which shows a long leg doji, which occurs when the open and close of the period are fairly close to each other in the center of the period's range, in which case the weekly chart is a week. It usually indicates indecision and a kind of a draw between the bulls and bears. And there's an air of tentativeness. Follow-up action usually determines the next phase of the price move. We need to watch 97.20 as a resistance above which a breakout will occur, and 95.20 below which bulls are at a disadvantage. Now, here on the weekly chart, the price remains above its 25-week exponential moving average, which is approximately 6 months holding on cost. So, the medium-term outlook is also positive for now. Last week, I advocated a range between 97.10 and 95.05, which held perfectly well. In the week ahead, I expect an estimated range between 97.15 on the upside and 95.05 on the downside. Keep an eye on the dollar because bond yields, commodity markets, equity markets, the outlook will depend on the US dollar index itself, will be significantly impacted by this metric. Friends, let's now go to the Nifty 50, the Bank Nifty, the Bank Nifty, which rose 0.48% after rising on 2 out of 5 trading sessions and held out mild hope for the bulls. Though it's early days yet, this could be a merely very feeble short covering. The price stayed below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. Long positions remain underwater and are demanding mark-to-market payouts. That's likely to worry the bulls. Remember, the rally last week was on falling impetus, as we saw the impetus chart earlier, and therefore is on shaky legs. Let's now move to the weekly chart, where one can see the price closing below its 25-week exponential moving average for the second week in a row. Now, this indicates a 6-month average holding on cost, which means the medium-term outlook is also negative. The last candle here is a long leg doji like we saw in the US dollar index Dixie's chart, and this shows an attempt by the bulls to halt the decline. Whether the attempt will succeed or not, the coming few days will tell. The first step will be to keep the index trading above the 37,000 round figure mark to stop selling pressure from nervous, weak hands. On the other hand, if this index starts staying below 35,300 levels, this will open the doors to further declines. This index is more vulnerable to the fallout of the interest rates firming up. Unfortunately, I don't see this aspect being talked about in the public domain. However, I do believe staying ahead of the curve, and therefore I will keep updating you on my social media accounts about the impact on the banking sector from the bond yields. In the week before last, this index was number 4 on the most volatile list, but rose one notch to end the week at number 3 as volatility escalated. Traders should continue to trade light due to the rising beta here. Last week, I advocated a range between 37,550 and 34,450, which held perfectly well. And the coming week is likely to see an estimated range between 37,725 on the upside and 34,600 on the downside. Last week I warned you, I feel this week also may see a range being exceeded as the statistical beta escalates. Continue to trade cautiously and with stop losses in place. Friends, let's now come to the Nifty 50, the most liquid and low impact cost trading instrument on the current F&O space on the NSE's derivatives segment. This index rose 1% and rose on 3 out of 5 trading sessions last week, but the price remained below its 25-day exponential moving average, which indicates a month-long holding on cost of the average retail long and buy hold trader. These bulls are underwater at this point in time where mark-to-market payouts are concerned. As and when rallies occur, weaker hands will try and bail out at break-even costs, and thereby they will offer overhead supply on upthrusts. Let's take a look at the weekly chart, which shows the last candle is a small bullish one with its body contained within the prior bearish candle's body. The price brushed below the 25-week exponential moving average but managed to close above it. Now this average indicates 6-month-long holding on cost, so even the medium-term outlook is mildly nervous. May I remind you, last week's gains were on falling impetus, which we saw on the impetus chart, and that is a sign of caution. Bulls will need to keep the Nifty spot trading above the 17,500 level consistently to convince the retail investors to start buying again. On the flip side, trading below the weekly low of 16,782 level in the spot might open up further downside potential. Do remember that the last week's up move was on falling impetus, which is a mild red flag. Although the Bank Nifty looks relatively weaker than the Nifty 50, it should be remembered that banking and finance sectors have the highest weightage in the Nifty 50. So a drag is inevitable if the Bank Nifty falls. In the week before last, this index was number 7 on the most volatile list but fell to number 9 last week because the ranges contracted a bit, as also individual stock volatility shot up in relative comparison. This individual stock volatility calls for abundant caution. Last week, I advocated a range between 17,500 and 16,500 on the Nifty, which held beautifully because the high was 17,490. Note, it was a mere 10 points below the resistance area that I specified last week, and it held in spite of all the volatility. The coming week may see an estimated range between 17,700 on the upside and 16,650 on the downside. Here again, there exists a slight threat to the violation of the range due to the high beta. The Jensen's measure and Sortino ratios do not justify aggression in the markets, especially on the F&O space. So please trade light and hold your stop losses very diligently. Friends, indices done. I come to the most popular segment of this video, wherein I give you 5 stocks which are high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus, where you take big exposure and wait for small price moves. Why the difference? Different attitudes and aptitudes of traders, therefore different techniques. So the high beta list is led by IEX at number 1, number 2 Dabur, number 3 Idea, number 4 Navin Fluorine, number 5 TCS. The low beta, low impetus list is led by MGL at number 1, number 2 Naukri, number 3 OFSS, number 4 Amar Raja Batteries, and number 5 Coromandel Fertilizers. Friends, this hierarchy of high and low beta stocks changes hour to hour, day to day, so it is subject to change. Please connect with me on social media. I keep updating this data on an end of the day basis, and stay tuned and stay updated. By connecting with me, we can get conversations going and help each other become better traders. I thank you for your patience in watching this video. Please do subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, do let me know how my videos are helping you become better traders. And please refer my videos to your family and friends and help me reach out to a wider audience of people who are looking forward to a sense and sensibility of knowledge-based investments and trading. Friends, in the description segment below this video are hyperlinks to my YouTube playlist on Equity Masters YouTube channel. Please subscribe to that playlist and get my ideas from there. There's also a link to a free trading guide from Equity Master in PDF book format. Please avail of that as well. I wish you have a very, very profitable day, my friends. Thank you for your patience. Take care. Bye-bye.